Hello, and welcome to the August Market Update webinar. My name is Dan White, one of ARK's Associate Portfolio Managers, and I will be moderating today's call. This call was pre-recorded on August 15th, 2025. With that, I will now turn it over to ARK's CEO and CIO, Cathie Wood. Cathie?
Thank you, Dan, and thank you everyone for joining us. Just a quick market update as usual. You can go to our In the Know podcast and YouTube video to get more detail. But just to update that a bit, it does seem like the outlook is evolving the way we expected. GDP growth is slowing. I think we're hearing a lot more stories about a weak consumer. The labor market numbers were terrible, especially the massive, I think it was a 257,000 downward revision that has caused a lot of drama in the administration. And yet that's very typical when we are entering or when we're in a recession, I should say. Now, we've been saying rolling recession for some time. We think we're coming actually to the end of it. Employment is a lagging indicator, so this does not surprise us. Inflation, very interestingly, the CPI and PPI, which did come out after In the Know, the CPI is behaving very well, and the PPI is not. It is more hit. It has been hit more, or boosted more, I should say, by the tariffs. But what I think this is saying is that the consumer-based companies cannot push along these cost increases, and therefore their margins are suffering. If they try to raise prices, they're losing units, and that is very damaging to margins for these manufacturing companies. And the other thing we know from the CPI is we're going to have at least a 1-year tailwind from rents, that the rent increases decelerating and actually then declining. That should be getting in for the next year. So we've got growth slowing, inflation slowing. If you look at Trueflation, which is the real-time indicator focused on thousands of items in real time, that is at just about 2%. It had been as low as 1.78 recently, so the tariff increases have taken it to 2% on a year-over-year basis. So again, a surprise on the low side of expectations, given the impact of tariffs. Then we come to interest rates. Interest rates have been very well behaved, even after the PPI came out much stronger than expected. Interest rates, yes, they went up a bit, but they're still quite low by even recent historical standards. Especially on the long end. If you look at the yield curve on the short end, so the 2-year Treasury yield versus the 3-month Treasury yield, it still suggests that the Fed is restrictive and maybe increasingly so. So we do think that there will be interest rate cuts in the month and maybe months ahead. If we're right on inflation, we're going to see quite a few interest rate cuts. And then finally on profits, it's interesting, while the consumer companies are having trouble, profit growth has held up pretty well on balance. I think the S&P earnings are running around 10% on a year-over-year basis. Now, how can this be when nominal GDP, which includes both real GDP and inflation, is slowing down? The difference is productivity. And so we're seeing innovation, especially AI, help companies become more efficient and more profitable. So very interestingly, when we think about productivity, we can see companies turning it around in many ways. It can drop directly to margins, and it seems like that's what's happening right now. But over time, we do think it will be dissipated in other ways or turned around in other ways, better said. It could be that it'll turn around in lower prices or increased R&D because of the massive opportunities evolving now in the world of disruptive innovation, or in perhaps workers' comp, especially in the more competitive industries. So we're looking forward to a very interesting next year. We actually think we're going into a boom, a productivity-led boom. And the boom we think will be even stronger if prices start falling, which we think they could, certainly in the areas of innovation around which we've centered our research and investing. So with that, Dan, take it away.
Yeah, thank you, Cathie. We'll be getting to that investment question very soon. But before we get into the Q&A, these questions are submitted through our clients, our distribution partners, and sent to our Funds X account and Instagram account at ARK-Funds. So if any listeners have any questions, please reach out through those channels. And this first one, Cathie, as promised, coming back to you. So how do you structure your investment process to adapt quickly to the rapid pace of AI while maintaining a long-term portfolio focus?
Well, this is a very interesting question. I founded ARK to focus exclusively on disruptive innovation, technologically enabled. So we are set up for this environment. We expected rapid growth. In fact, one of our taglines is invest at the pace of innovation, interestingly. And as many of you know, if you follow our research, which we do give away, we start our analysis at the top, trying to size new markets based on the learning curves associated with new technologies and how quickly costs are falling because of those learning curves. And we estimate how long it will take for these technologies to scale across sectors or industries during the next 5 years. So we're set up for exactly this kind of environment. And then the bottom-up steps of our process are focused importantly on and scored for the first four. There are 6 metrics. The first 4 are scored. Company, people, management, and culture. So that's the first one. Do we have a visionary leader who will stand up to short-term oriented shareholders or venture capitalists and invest aggressively to really come out ahead and capitalize on these super exponential growth opportunities? Execution. Are these companies spending enough on R&D as a percent of revenues? And are as important, maybe more important, is are they spending their R&D dollars in the right places? And again, we have a point of view informed by our top-down analysis on the right areas for R&D focus. Another one is moat. This is very important. The moat, many people think, is very importantly about patents. And in some cases, especially in healthcare, that's true. But today, it seems the moat or the barriers to entry are focused more on speed of execution and moving down the learning curves, meaning costs coming down as rapidly as possible to scale across sectors. Then there's product and service leadership. Of course, there are a lot of polls and social media is full of responses to different products and services. So we can learn a lot there as well. And then, of course, valuation is critical to us. We've gone through valuation a number of times, but we have a 5-year investment time horizon. And we assume that our companies or the stocks of ARK companies, their multiples, enterprise value divided by adjusted EBITDA, that they decay or compress to nearly a market multiple in most cases, or to the average multiple over the last 10 years for a given company. So we assume multiple compression if our portfolios are selling at a premium to the market. And they are now, so that compression is an automatic part of our valuation. And then finally, thesis risk. And very often that's government regulation. And I think one of the most wonderful things happening today is the amazing deregulation that's taking place in this administration. They've made it a primary focus, and they're running hard with it, and even in healthcare. So we're pretty excited about what's going on.
Thank you, Cathie. Our next question here is for Frank. So, Frank, is there the potential for large language models to become commoditized? And kind of a follow-up to here, is this a winner take most market?
Yeah, it's a great question, and we get it pretty often. So happy to walk through it. And I think when you think of the model builder companies, what we've seen is almost simultaneously or two opposing trends at the same time, where we're observing more competition, while also in other ways a narrowing of the field. And so to explain the former, for the past a large majority of the last 2 years, it was really OpenAI setting new frontiers, and then the other competitive model building companies like Google, Anthropic, XAI catching up to the frontier at some lag. And what we've seen is that the pace at which companies catch up and the size of the leapfrogging as new models come out has become much more competitive. And all four of those companies that are really playing at the frontier kind of trade off who has the best model and who's, having the next increment that's better across different domains. And so in that lens, whereas OpenAI had been on the model side, really pushing the step function changes, it's gotten more competitive. We've also seen on the open source model side, China become increasingly competitive. First with DeepSeek, but now models from Alibaba and other companies are increasingly competitive with models in the U.S. Both models from U.S. companies, I should say. A lot of these open source models coming out of China are ultimately run on U.S. clouds and used by U.S. companies, which is an important nuance. But there's kind of competition from that front as well. Now, when I say the field is narrowing, there are a lot of companies over the last year or 2 years that raised a lot of money that did not train a good enough model, did not get enough momentum to compete at the frontier. So you have companies like Inflection AI and Stability AI that had turnover in the teams, a pivot or a total restructuring. And the list goes on through a longer tail that can no longer compete with the capex required with that to train a frontier capable model. And so, at the same time as you have growing competition of the companies that are at the frontier is separating from the rest of the pack. And as you're thinking of these kind of offsetting dynamics in answer to this question, I think it's important to remember that the foundation models themselves, the large language models, are just one layer of the stack of an AI solution. And you really, when you look at the products and services that AI is embedded into, you have a kind of a much more nuanced look depending on the use case and the user. So on the consumer side, you have kind of the vision of a personal agent that can do all of these tasks for you. And that's the market that ChatGPT is really, despite maybe not having day by day the top model or the step function change in model, that's the market that they're really leading in with over 700 million weekly active users. The fastest growing, interestingly, is Google, which is why if you're paying close attention, we've acknowledged that as well as the strength in Google Cloud and added Alphabet into strategies like ARKW. And then shifting to the enterprise side, I think you're going to have, just like in cloud software today, a mix of horizontal platforms and vertical specific platforms. We're seeing that develop where The enterprise versions of the AI agents are one example of a horizontal productivity tool. Companies like Palantir that are building the critical data and application infrastructure to make AI useful within enterprises is another example. Developing in this horizontal category, and then vertical categories and winners like the coding agent space, which is one of the fastest growing areas of software, where you have companies like Cursor and Replit that have grown their revenue base by over 10 times in less than a year. So growing tremendously quickly and focused on a specific niche, which in this case is autonomous software development. And so I think you'll see specialization and different companies winning at each of these tiers, and they're picking from the best model available. And so OpenAI may be positioned to use their models the best because they're creating them, and that creates an advantage. But a company like Replit is switching from the best coding model that's available. OpenAI, when they just released GPT-5, actually announced that Cursor, the most popular coding agent, is switching from using Anthropic to GPT-5 to support their product. And if Google or Anthropic comes out with a better coding model than GPT-5, they will probably switch back. So depending on the use case, you will have more commoditized use cases and others that are more differentiated. Another important nuance is that outside of the maximum intelligence or raw performance of a model, there's more nuanced characteristics like the personality of the model and the level of personalization that you're building into the product that leads to a sticky product over time. And I think that's what OpenAI has done well in adding memory and more personalization to ChatGPT, and they can use their base of hundreds of millions of users to improve that product over time. But also where they got blowback with launching GPT-5 because it had a new personality than the prior generation model that turned some users off. So we're really learning new dynamics of the competitive vectors here. And I guess just the last thing I'll say in summary on the enterprise side of things, there'll be horizontal plays, there'll be vertical plays. But we think a majority of the value will be in these horizontal plays, which is why Palantir is a high conviction name for us.
Thank you, Frank. Alex Karp mentioned something on the earnings call with, kind of on that, not just the LLMs. What was that again?
Well, I think he said something along the lines of LLMs don't work without Palantir and don't work without the ontology, which in a business context is really providing not just the model that is intelligent, but providing it with the right data at the right time and the right tools to actually affect change within an organization. That is really what the Palantir platform is built for. So it makes sense that they're, seeing the adoption they're seeing and being able to deliver these amazing examples of value and productivity for their end clients, because the clients all want to use AI, and Palantir really gives the tools to make that possible and integrate AI into your existing data assets inside an organization.
Yeah, I'll just add something there. It was a very bold statement toward the beginning of the quarterly call, and he said, large language models do not have common understanding. They need Palantir if they're going to work within an organization, right? Something like that.
Yeah.
Great. Thank you, Frank, and thank you, Cathie. For this next one, this next question is for the Multiomics team. So how are broader government, macro, and FDA factors influencing the healthcare sector? And how might those dynamics shape and shift ARKG's path forward to closing the performance gap with the rest of the ARK suite?
Yeah, thank you. It's a great question. So from a big picture standpoint, we see a few major forces here shifting that could support ARKG's performance. So thinking on the macro backdrop, Cathie has highlighted several elements here earlier, but to hone in on a point here, high interest rates and tight capital have been pressure points for healthcare innovation. So when you consider many of the companies in this space are still years from profitability and rely on outside funding to advance their programs, having the cost of capital improve is really important. This is meaningful for early stage innovators, making it less expensive to fund their multi-year clinical programs and helping extend their financial runways. Thinking on the level of strategic activity, well, we have to remember, so large pharma here is facing a massive patent cliff by the close of this decade, so over $200 billion in annual revenue at risk by 2030. Now, historically, large pharma will often look to innovative biotech companies to replenish its pipelines. So thinking in early stage biotech, these transactions are a key form of strategic price discovery. So they set real world benchmarks for what innovative platforms are worth and help public markets calibrate valuations accordingly. And of relevance here to just highlight, so back in June, we saw Eli Lilly acquire Verve Therapeutics for $1.3 billion. Verve is a biotech company leveraging Beam's base editing technology to develop in vivo single course therapies aimed at lowering risk for cardiovascular disease. So for the first time, we're seeing a major pharmaceutical company making a substantial bet on in vivo gene editing targeting a common disease. And this is really important validation for gene editing space, and I would not be surprised to see this kind of strategic activity continue. And the third one is really important here that I would highlight, and that's the new FDA that we're entering. So Dr. Marty Makary was appointed this spring as FDA commissioner, and he's been very vocal about ushering in a more modern and responsive agency. So his state priorities include gold standard science and common sense in regulatory decision making. So this is looking like partnering earlier with innovators, integrating more modern tools like generative AI and big data into the review process, for example. And the ultimate goal here is to make the FDA more efficient, streamline regulatory pathway, and reduce regulatory uncertainty. These are really key steps that would be expected to shorten development timelines and lower capital burn for companies. So we can't promise outcomes, but we believe these shifts are important and create conditions within ARKG and in our multi-omics exposures for our ARKK are certainly ripe for playing catch up.
Just to put an exclamation point on the FDA, I think this has been the biggest surprise in terms of deregulation and how quickly it is happening. And another example is the FTC, which in the last administration really did not allow much in the way of M&A, especially not by large companies like large pharma. That is changing as well in this new administration. So those are two examples.
And maybe just to add one more aspect here is that we know that this administration has been very kind of focused on the China as the potential competitor and across the different sectors. And, I think in the biotech and the healthcare, they had been really ramping up on China side. So we have definitely noticed a trend that many of the pharma companies actually now go and acquire assets in the China versus here because they are cheaper. And so they are definitely more efficient in actually bringing to phase 1 or phase 2 the assets. And so the pharma will go there and acquire the asset. And so we have to kind of ensure, and I think this administration is in line with that the center of innovation is actually staying here and is not moving to China, which at the moment it seems it could be a possible option.
Thank you, multi-omics team. Some exciting tailwinds for the entire genomic space. And Nemo, I actually have one more for you too. So Tempus AI is one of the larger holdings in the ARKG fund. They recently had an earnings report. Could you please just provide the listeners an update?
Yeah, absolutely. Happy to. So Tempus had a really good second quarter. So the revenue was about 340 million, and where the genomics was about 240, and the data and services were 72 million. Just for reference, data and services growth is 35% year over year. Interesting thing here, the Ambry Genomics, their acquisition, had a really good quarter as well, which was not expected. And so just a reminder, Ambry Genomics basically kind of focuses on whole exome sequencing and whole genome sequencing in the mostly for the rare disorders. So they had been doing really well. And I think, what is this signaling to me is that Tempus acquired Ambry Genomics because they actually wanted to be exposed more in the rare disorders space and maybe even the newborn sequencing eventually. And again, I think it is all big picture. What Tempus is trying to build is the kind of ultimate, true powerhouse when it comes to diagnostics. They started first with cancer. They have a huge database. That's their kind of biggest franchise. But then they had been developing on the cardio side algorithmic tests. They have neurogenomics kind of tests. with Ambry Genomics, they want to enter rare disorders. I think they want to be like a one-stop shop for the diagnostics. And it's not only kind of diagnostics how we are used to that. You do a test and then there's like a binary decision, but it's really thinking about this intelligent diagnostics, how they call it, or like how I think it's more like a continuous diagnostic, where they want to be able to kind of over the lifetime they can kind of diagnose different things for a patient. So I would say that in our mind, they're the kind of only company that's really taking this AI first approach when it comes to diagnostic. A lot of our portfolio companies is using AI in the diagnostic, but Tempus is really taking this to another layer and actually coming first from that angle. And when we were talking, I think last week, I think we talked. In my mind, it came. Tempus reminds me a bit of the Tesla. Tesla is primarily AI company which is using the vehicles basically to collect the data to make the AI model. So this is how Tempus approached it. Think about diagnostic. All these tests which are helping the patients and doing the things, they're for them the vehicle, the way to actually collect the AI, collect the data to train the AI on that and kind of build a foundational model.
Yeah, and yes, I guess, again, another exclamation point here. I think Tempus probably is the company we've been looking for that will be really the information backbone of the U.S. economy. Right, Nemo? Thinking about it in those terms. And AI is winner take most. We talk about Tesla that way. And in this way, we think this company probably is the closest or has the highest odds for winner take most.
Yeah, it can be absolutely. So again, we are thinking about where diagnostics is truly being preventive, predictive, and where actually the biggest value that is being created is actually in collecting the data from the patients. And so Tempus is really positioning themselves there to be at the center of that. So we think that this really, and if you think that how healthcare is a big spend, right? And having a Tempus at the center of that, because it's kind of collecting the data and then enabling this kind of preventive and predictive medicine, it really puts them, as I said, at the center of the whole this sector.
Thank you, Nemo and Cathie. Certainly a really exciting company in the healthcare space. All right, these next questions are, Sam, turning to you on the robotics and autonomous team. So according to your modeling and your team's modeling, what does timing look like for humanoid robots at mass scale and adoption?
Sure. I think people are very excited about mass scale and adoption. We think this is probably more in the 5 to 10 year time frame. And to contextualize this, it's not about making them. It's really about what can they do. And there we're seeing tremendous improvement on the AI front. There's a number of companies looking to produce in the thousands in the next year. Elon and Tesla have come out saying, they want to get to roughly 1 million in 5 years. But if you think about what is mass adoption, at scale, there's the potential for billions of these, right? So it's like 1 million is impressive in the scale of industrial robots where they stand today, where just roughly 500,000 are being sold on an annual basis. So this is going to completely transform the robotics industry. But the potential here is so large that really getting to mass scale is going to take time. At the same time, there's exciting developments that are being ticked off in the near term. Useful applications just in factories. Other demonstrations of folding laundry or some task at home. And so it's going to be a very exciting future on the way to true mass scale, which is going to, we believe, transform what the economy even means. But that will take time.
Yeah, so moving from the cool and exciting dance videos to real functionality across different industries.
That's right. Don't sleep on the power of dance, Dan.
Yeah. I need some help there. We all know that too. The next one, Sam, I'm going to stick with you here in the eVTOL space. Could you please compare your 5-year outlook for Joby and Archer, two names found in the ARK funds?
Sure. And I think this is a good question just to tee it up, because on one side, the question gets it right, I think, and on the other side, confuses it, where it's like, where is this question on the nose? From our research, these are the two companies that are pushing the frontier of eVTOL. Where do I think this question kind of frames it incorrectly is, putting them one against the other, right? This is an industry that's at a nascent stage that should have multiple winners, and so I don't think it's one versus the other. And when we look at both of them, they're tackling things in different ways, right? Joby's testing in different ways. They're hoping to own and operate at the start. Even this morning, they just did a test flight between two public airports. Archer is moving very quickly. They started later, but have caught up in a tremendous way. They're looking to sell aircraft, not necessarily operate them. But both of them, in the next 5 years, I think are on a similar goal trajectory, which is to commercialize in the next year in the Middle East, then get that approval in the United States, right? Archer, hopefully within the next 5 years as the official eVTOL provider in the LA Olympics, will make it truly magnificent games where you're not stuck on the 8-lane highway, but you can actually see the sports you want to. And at the same time, we would hope that Joby is approved in the US as well, and this will relieve all of the increased traffic from the autonomous vehicles on the road.
And just one more difference, I think, is the exclusive relationship between Anduril and Archer. So it is a defense play as well.
Thank you both. Sam and Frank, I think this next one's for both of you here. So, big headline the other week with Tesla shutting down DOJO. What does this mean for the company and for its shareholders?
Yeah, I can start on that. And just to give a little bit of background, Tesla has been building their own custom chips, and they've had them in production since 2019. They were talking about it and working on it years before that, and really started with in the car, where they've been very successful. They're on their second generation chip that's in cars now. The naming is a bit confusing, but it's the AI4 chip. It's their fourth generation of hardware. They used NVIDIA prior to swapping over to their own custom chip in 2019 with what they called Hardware 3. And now the current generation chip is AI4. And that's the reason to build your own chips is because it allows you to, if you have a very specific workload, improve the performance and have greater fine level of control over how the chip is built, purpose for specifically for the workload. And it also allows you to move at your own timeline versus the timeline of a vendor like NVIDIA, for example. So that's been very successful in the car, and Tesla, seeing the success of that, starting in 2019, but really, talking about it more publicly in 2020 and 2021, launched efforts to build DOJO, which is their custom chip for training in the data center. So this would be a competition with NVIDIA, for example. And I think the announcement of shutting down DOJO, they did DOJO 1 and have been working on DOJO 2, is a recognition of a few things. One is a consolidation of resources and focusing on their custom chip efforts on the in-car chip, and a realization they had real competitive differentiation there. Whereas in the data center side, keeping up with the pace of change of NVIDIA is hard. And if you're thinking about consolidating resources, consolidating down into the chip that is really differentiated in the car where the end workload is working makes sense. And it's also because they've been using that chip in the training process itself. So Tesla has, I think they've said over 20,000 hardware 4 or AI4 chips in the data center that they use for part of the workload that they use to train their models when they're taking raw video data into the data center and doing the perception processing before it gets fed into the GPUs for the downstream parts of the training process. And what Tesla announced shortly before the termination of the DOJO project is that the AI6 chip, so not the generation that's going into cars next year, which will be AI5, but the generation after that, their intention is to make it as good as possible at both inference in the cars and training in the data center. So we'll see as we get closer to that timeline. It's going to be probably 3+ years out, what they're able to do from a design perspective to make it efficient in both use cases. The other piece of news related to this is that Tesla announced that they are going to be working on the AI6 chip with Samsung on their US-based fab in Texas. And they have a special agreement where Elon will be walking the floor of the fab to maximize efficiency. So this is another angle of vertical integration and specialization going down to the chip manufacturing level itself, not just the design level. That should yield, if successful, even more differentiation over time.
Great, thank you, Frank. This next one, moving into the crypto sector, a lot of kind of news and excitement around this area recently. So Lorenzo, a new name that's found its way into the ARK funds, Bitmine Immersion Technologies. Could you walk us through the investment thesis for this name?
Yeah, of course. So to give a bit of background, so Bitmine Immersion is led by Tom Lee, and right now it's the biggest Ethereum DAT, so digital asset treasuries, and these are companies that are trying to accumulate as much Ether as possible. And so really, when we looked at the ways to get exposure to Ethereum, right now the main problem with the ETFs is staking, right? The big difference for Ethereum and Solana compared to Bitcoin, for example, and MicroStrategy, these networks have a native yield. So for Ethereum, it's about 3% right now. For Solana, it's closer to 4 to 5. And so the ETF right now are not allowing staking. And even if that were the case, really, because of liquidity and how these networks work, right now, because of the high usage of the network, you have about 2 weeks to stake or unstake Ethereum. And so this really makes it very difficult for ETFs to stake the majority of the assets. So we think they're probably going to be able to stake between 30 and 50%, which obviously lowers the net yield. And so we think Bitmine and other DATs with the permanent capital structure are actually a very efficient wrapper and are actually better. And so regarding Bitmine in particular, for the investment thesis and the outlook, I think really the focus for the next, I would say, foreseeable future is going to be to accumulate Ethereum. And so when you look at, just to give an example, when you look at the window from July 13th to August 13th, Ethereum went up 60% in that 31 days window. And Bitmine Immersion was able to increase their ETH per share by 130%. And so actually, the way Bitmine is issuing shares at an MNAV premium to buy back Ethereum has actually been very accretive to shareholders in that time frame. And so if you look at long term, with the yield right now, Bitmine has about 1.2 million Ether. That's about $5.5 billion, more or less, depending on price. And so the yield is about 150 million yearly, which is very significant for a company that is very lean. If they were to, use that in a future for other purposes, they would obviously have to sell Ether. But that is pretty sizable, and we think the use of ETH as collateral within DeFi, there are many use cases and things they can explore, and so we do think it's a winner takes most right now in the market, and so we're excited to to back and invest in Bitmine.
Great, thank you, Lorenzo. Next one's for you too as well. This is our final question in the stablecoin world. So, and maybe you can explain sort of the acronyms here as well as who owns these. So, how are USDT and USDC different?
Yeah, so USDC is the stablecoin issued by Circle, and USDT is the stablecoin issued by Tether. In terms of the technology really underlying, it's extremely similar. These are smart contracts on Ethereum rails and on Ethereum and Tron mostly for Tether. So technologically, it's very similar. The biggest difference is, I think, the user focus, the geography, and really the backing of the collateral right now. So between both, they have, I think, more than 90% of market share. So they're really the two biggest stablecoins issuer. USDC is backed by short-term US Treasury bills, and USDT is also backed by short-term securities, but has a portion of the collateral that is invested in precious metals, corporate bonds, Bitcoin, and secured loans. And so right now, in terms of the collateral, that is the biggest difference. And in terms of use cases and really geographies, USDT is really dominating emerging markets. So there are extremely present in Asia, Africa, and Latin America. And USDC, especially with now the Genius Act, is more focused on developed markets, and so Europe and the United States. So those, I would say, are the main differences.
And I'll just add, I'll add one thing to that. There has been controversy over the collateral backing USDT. As Lorenzo said, it's a combination of treasury securities as well as Bitcoin, gold, secured loans, as Lorenzo said. I think, and please correct me, Lorenzo, 80%, 75 to 80% is US Treasury securities. And one of the interesting nuances here that we've been exploring is, what does stablecoin mean? Right now with USDC, it's effectively pegged, it's pegged to the dollar and backed by US treasuries. USDT, with the addition of Bitcoin and gold, has a little bit of a different flavor of quote unquote stable, in that it's geared almost for a stable purchasing power way of thinking. Now, they're both going to evolve in different ways, so we'll see what happens. And we don't know what they're going to do, but that's just a little hint that there is that difference between them evolving.
And for anybody that's interested in diving into that difference in detail, we did a podcast with Paulo from Tether and the Art Laffer, which I think is really interesting to tune into if you want to explore the topic more.
Thank you, Frank.
Great, thank you all. And with that, that will conclude today's webinar. We will briefly show performance statistics that can also be found on ark-funds.com. Thank you to everyone who listened to today's call, and once again, thank you to the ARK team.